And this video, we are going to do an overview of the commercial banks industry. Commercial banks are the largest group of financial institutions in terms of the dollar value of assets. When we say commercial banks, we are distinguishing them from the personal banking banks, which is the ones that everyday consumers use, and investment banks and all other kinds of financial institutions. Now, they pretty much work the same as a personal banking institution, but they deal with businesses mostly. Also called depository institutions because a significant proportion of their funds come from customer deposits. Major assets are loans and major liabilities are deposits. More on that in a moment. Perform services essential to U.S. financial markets. They play a key role in the transmission of monetary policy, provide payment services, offer maturity intermediation services. Banks are regulated to protect against a disruption in the provision of these services and the cost this would impose on the economy and society at large. So they do serve pretty much the same functions as a personal banking institution within the financial sector. Regarding the major assets are loans and major liabilities are deposits. All that means is that banks sell loans. So that's the product they sell. So that's their assets. Meanwhile, the deposits they receive, as in a business deposits on their checking account, that money is in the bank, but it belongs to the depositor. So it's a liability to the bank. Just like you see here, that's why a commercial bank and a non-financial firm, just a Walmart, for example, they have the loans and deposits flipped between assets and liabilities. As we explained, for a bank, the deposits of the customers, that cash is a liability because they have to be able to provide that cash to the customer when they want it. What they sell are loans, and that's their product. However, let's say a Walmart or any other company, corporation, or business, they borrow money and then they have to pay it back. So to them, that's a liability. And then whatever they sell, they get money for, and that's their cash on that end. While loans are the majority of the assets of a company, they also have other assets like any other company will have them. But another one to keep an eye on or to be of interest is the investment securities, which generate interest income and provide bank with liquidity. This is not unique to banks. You may have seen balance sheets of other companies that have marketable securities or something in that nature. So they're highly liquid tools that also belong in the asset side, and they provide income through interest earned. Commercial banks assets continued. Commercial banks face unique risks because of their asset structure. Yes, that's a whole course on itself, and a very important part of commercial banking is classifying and diversifying the risk. There's another course that gives a lot of detail into that. But here are some of them. Credit, known also as default risk. Credit risk is the risk that promised cash flows from loans and securities held by financial institutions may not be paid in full. So if a loan is an asset, but the person or the bank, or I'm sorry, the business you lent the money to does not pay you back, there's a risk of that. The closest thing I can think of on top of my head of a non-financial institution, a non-bank that has a similar risk is accounts receivable. There's a risk to that, but it's not only is a greater risk to banks as credit default risk, it it has a whole different set of implications in the financial sector. Liquidity risk is the risk that a sudden and unexpected increase in liability withdrawals may require a financial institution to liquidate assets in a very short period of time and at low prices. So, generally speaking, banks take deposits from customers. It's like a checking account or savings account, but they're only required to keep a percentage of that money at hand. That's called the required reserve set by the Fed. They can lend out the other percentage. However, all of a sudden, a lot of depositors come in saying, I want my money, I want my money, this great percent of liquidity risk. And the bank is going to have to find a way to get that cash. And then, as you see, they may have to then start liquidating stuff in order to provide that cash. This example, it's called the run on the bank, is because everybody runs to the bank to get their money. Interest rate risk is the risk incurred by a financial institution when the maturities of its assets and liabilities are mismatched and interest rates are volatile. This here comes from a matching principle where it is always recommended that the maturities of your assets and the maturity of your liabilities have the same time length. But if they don't, one is short term, one is long term, then you may have an interest rate risk problem. Now, it's not to say that you cannot have different maturities, but if you have so much in short term liabilities, then you should have so much in short term assets, and so on with medium and long term, etc. Credit, liquidity, and interest rate risk all contribute to a commercial bank's level of insolvency risk. The risk that a financial institution may not have enough capital to offset a sudden decline in the value of its assets relative to its liabilities. And that's just the overall risk, what they're talking about in that last bullet there. Regarding the liability sides, we'll talk about the deposits. So the transaction accounts and the deposit side, those are like your checking accounts and your regular savings account. There's different types of savings accounts, but the ones that you can withdraw your money right away without having to wait or pay any penalty, those are your standard checking and savings accounts. Those are the ones they're talking about, the transaction accounts, meaning that the person can ask for the money on the spot. And as we spoke before, that brings some risk to the bank. However, there's other ways your money can be in the bank, and household savings, time deposits, CDs, etc., money market. Well, those provide the bank a little bit of extra safety or lowers its risk because the person is less likely to withdraw on the spot. And if they withdraw, there are some fees or penalties associated with it if they withdraw early. However, you would earn a higher interest for having that money in those types of accounts. And that's the trade-off. They give you a little extra in order for them to be able to use that money without increasing the risk at the bank level. As we move through the liability side, we spoke about deposits, which are the ones that represent the higher risk to the bank because of the quickness that the depositor can claim. Then we can move on to what will be called non-deposit liabilities. And these are when you buy, for example, bonds, notes, other federal funds, etc. They have short and long-term maturity. And as spoken before, then now the bank knows that they can count with this money for a certain period of time. And it's not that at any given moment somebody's going to come and pull out the money. And so, but it's still on the liability side, just not as risky for the bank. On the last but not least, on the equity side, it's pretty much like any other balance sheet, assets minus liabilities, whatever's left, that's the equity side of the equation on the balance sheet. And as before, it's typically common and preferred stock. And you may have some surplus or additional paid-in capital, and you will have some retained earnings. So it's pretty standard on that side. One thing that is different about how the equity is regulated than your non-financial institution company is that they have to pass periodic stress tests because they got to be what we call properly capitalized. In other words, the you can say debt to equity ratio, things like that could be way to test them, uh, which non-financial companies have a lot of freedom of how much debt they can have and let the market run its course. However, banks are, because of the nature that they have other people's money and their impact on the economy, then that part is regulated. The risk levels they can have limits and are watched and observed. Just like other businesses, there are off balance sheet activities. They're typically within the banking world, letters of credit, commitments to lend, and as in the entire business world, derivative transactions like future contracts, forward contracts, options, and swaps. Now, what happens is while these are on paper and some money may have gone that way in order to get these started, they are not on the balance sheet nor the income statement until something happens. And that's what they mean when an event occurs. Once the event occurs, an option is exercised, for example, or a letter of credit is utilized, then they are logged in the appropriate place in the balance sheet. But while they're still open and not, I don't want to use the word exercise, that's very specific to options and some derivative transactions, but until the event occurs, until something happens with these things, then they start showing up on the assets and liabilities. Now, this is important because these things that do not show in the balance sheet or the income statement until the event occurs still represent a risk reward situation of the institution, especially on the risk side. So it's important to be aware of them if you are either evaluating a bank or if you work in the bank as you make decisions and engage in other transactions. So just because they don't show on the balance sheet or the income statement anywhere, it doesn't mean there are things out there that also impact the bank. Some other significant fee generating activities besides the lending portion of a commercial bank, loans being the big one, they can offer trust services as well. Typically, only large banks offer these because these are for very large amounts of money. And then there's correspondent banking, which is kind of like a bank to bank services. Now, shadow banking. While it may sound like something illegal, it is not. And the simplest way to define this is a company or organization engaging in transactions and activities that are like a bank, but they are not a bank. Now, of course, they will not be able to do the entire a suite of services, but private lending, for example, technically speaking, I can at any given time give a loan to business on a private note, and there's nothing wrong with it. The issue is that because these are not financial institutions, the regulation is low on how it's monitored. There's some regulation, but not as tough. And there are calls for more regulation on it because of the impact it can have in the financial sector, uh, which is true, but we should also consider that the banks, the actual financial institutions benefit if there's more regulation on the non-financial activities, non-financial institution activities, because it's a matter of competition. Either way, it's out there, but it's not illegal as it sounds. And like any other business, the bank size and activities matter in the sense of what they cannot do, or what they will focus on given their capabilities. For example, small banks typically focus on the retail side, generally hold fewer assets and liabilities than large banks. Well, that's for the kind of like a self-defined. There are small banks. Rarely hold derivative securities. There's many reasons for that. One of them, those are higher risk, higher reward tools, and you can't really take advantage of them in many ways for hedging purposes unless you have large amounts of money moving or very complex transactions. So it's not just a risk reward, or they don't have the money, as that it may not be as efficient for them to use those. More sheltered from competition in highly localized markets, lend to smaller, less sophisticated customers than large banks. In other words, large banks are pickier, but they can because they're large banks. So they want the large, big customers. Now, the large banks usually engage in both retail and wholesale banking, but focus on the wholesale side of the business. Operate with lower amounts of equity capital than do small banks, tend to use more purchase funds and have fewer core deposits, lend to larger corporations, which means their interest rate spreads and net interest margins have usually been narrower than those of smaller regional banks. What that means, to catch those people that, let's say, are going to borrow $150 million at a time, they now have the power to try and negotiate better interest rates because it's large amounts of money. And in order to get that if you are going to borrow that large amount of money, you are going to be a big customer. So then those things are more negotiable and other services are negotiable. So that's why their margins and interest rates spreads are smaller. However, the actual money they're going to make out of it is very large, because would you rather earn 10% on $100,000 loan or a 1% on a $300 million loan? That dollar amount is wildly different. And that's just a extreme example, but it delivers the message. There are a lot of regulators at the federal level and state level that monitor banks. These are just a few examples, some key ones, and they do more than what they're showing here, but it's typical that these are the typical things you may know them for. Federal Deposit Insurance Corporation, the FDIC, that is typically associated with the organization that insures your money up to a certain amount. So if the bank goes bankrupt or somebody robs the bank, the FDIC comes in and makes sure you didn't lose your money because it wasn't a bank. Then you have the Office of the Comptroller of Currency, the OCC. It's the oldest U.S. bank regulatory agency. And the reason is because the primary function is to charter and close national banks. So if you want to start a bank, they have to approve you. And if you don't behave well as a bank, they will close you. These are the people that also go around inspecting the banks from time to time. The Federal Reserve System, this is pretty much what you know as the Fed, is a central bank, is the one that's always in the news about interest rates. They also are the ones that regulate banks as well. And then those we just mentioned, those first three, those are the federal level, but then each state has their own state regulatory or institutions to monitor the banks in this within their state. Within the international discussion of banks, which is typically only the real large banks, there are some advantages and disadvantages to expand outside a country. Some banks stay within a state, some banks expand across the country, multiple states at least. Of course, we're talking about the United States, but the same applies to other countries. And then some of them choose to go international, go into multiple countries. Now, advantages, risk diversification. Just like all good old fashioned diversification, the more you spread around, the lower your risk. Economies of scale. The more you grow, the lower your cost per unit. Innovations, fund source. Fund source is a good one because about capital raising. There's a lot of money coming in from different places. Customer relationships. You're out there networking, you know more people. Regulatory avoidance. Well, avoidance, not evasion. If you want to do business in a country, but your domestic laws are different and prevent you from being able to exercise or do certain practices, then you'll have to consider going to another country to avoid some of your local regulations. Disadvantages, some of them, information monitoring costs. It's a more complex practice when you go into different countries, and now you have to deal with different things in different countries. For example, one of the big ones, it's about accounting practices are very different between countries. So you have to add the cost of translating accounting financials between countries to be able to consolidate them, dealing with taxes, uh, from the legal side, be staying up to date on everything on every country, and the monitoring is self-explanatory. Just more people to watch in different places. Nationalization, expropriation, that will fall under legal environment risk, which is things can change in a country and not always for the best of your business in there. The nationalization, expropriation specifically is where a country decides to shift within the social practices spectrum on government, and they may start nationalizing the banks, and all of a sudden they take over your bank or they kick you out of the country. Fixed costs, just in general, more fixed costs. Even if we go down as simple as saying the cost of a building versus the cost of retaining lawyers in every country, anything that is a fixed cost will multiply greatly because then you got to be country specific. You cannot spread, you can spread some of your fixed costs because that's where economy of scales come in, but you will be increasing your fixed costs overall because each country will have its own unique set that you cannot spread necessarily. That's it for this video. See you on the next one.